Hi, this is Senyuz. I'll be teaching investments in emerging markets this spring semester. There are three main stories out of this course that you can take. The first one is you need to acquire a directional macroeconomic bias from emerging market countries. Once you do that, you will create a portfolio that can be invested into these countries. In order to do that, you have to have tools to get invested into these countries. And the tools will be delivered in the second section of the course. That we will be talking about in equities investments, in debt, derivatives, and foreign exchange. Once you have the tools, and once you have the directional bias during the course of the semester, then you will be able to create a portfolio. And once you create the portfolio, you'll realize that you will have some countries as overweight and some countries as underweight. The overweight countries will enjoy lower cost of capital. The underweight countries will be punished with the higher cost of capital. The portfolio inflows and outflows will play a major role in this course, and for you to understand why some countries are overweight and some countries are underweight will be the key takeaway for the entire course. There are a lot of books written about emerging markets, and there's a lot of data that's produced out of these books as well. But let me give you a little more data related to that. Over the next 10 years, world's population will grow by 800 million people. And significant portion of those people will be living in emerging markets, and they will create a good amount of demand. But on top of that, there will be 1 billion, 1.5 billion people migrating from lower income class to the middle income class, and they will create tremendous amount of demand. That demand upcycle will be amazing. And when that happens, everything will change. I mean, how we do finance, how we do investments allocations, but moreover, who is going to dictate the credit terms will change. And let me talk about that. Go back to 1990s. 20% of the world foreign exchange reserves were in emerging market countries, and 80% of the reserves were in developed countries. And fast forward to today, that number completely changed. Now, 80% of the reserves are with emerging market countries, and 20% of the reserves are in developed market. And that data is displayed in the debt to GDP ratios as well. The emerging market countries' debt to GDP is much, much lower than the developed market debt to GDPs. So the guy that used to have a lot of debt in the past now has a lot of money and became a creditor. And the moment you become a creditor, you start dictating credit terms. And that's the most important story of this course, and this is the reason why you should take this course. This course is recommended to everyone, especially if you're interested in emerging markets, today's global markets, and also if you're interested in the future world economic order. I would recommend to all MSFS concentrations to look into this course. Yes, we will be doing some mathematical analysis, but it's not super complex, and a lot of people spends quite an amount of time to do it, but at the end, everybody does it. I currently work for Ashmore as Global Head of Equity Trading. And Ashmore is investing in emerging market countries, and we have a main office in London, but we have offices in many other cities, but not the cities that you would expect. We have offices in Istanbul, in Bogota, in Jakarta. We just opened an office in Riyadh, so we are a truly investment manager that's investing into emerging markets. We provide products in the fixed income space, in the equity space, and in the alternative space. Before Ashmore, I worked with a team designing order management systems, portfolio management systems, and trading systems, but my true passion is with emerging markets. I am originally from an emerging market country, and this is my passion. And 3 years ago, I designed this course out of that passion, and I believe it will be a very interesting course to be offered to everyone. So we have 16 seats available for investments in emerging markets course, and there are 23 countries within the emerging market index. Out of the 23, the top 16 constitutes roughly 95% of the index. So we will be covering almost the entire index within this course. Each student will be assigned to a country as a country analyst. As a country analyst, you have to follow the macroeconomic data that's produced from these countries every day. You have to also follow the micro data that's coming out of these countries at the company level. And also you have to watch the political events that's happening in the country that will have a market pricing effect at the final markets. So once you do that, you will be able to create portfolios. And in order to do that, we need to know what tools are available in emerging markets. So we will be getting into the equities investment, where we will be talking about ADRs, GDRs, locally listed stocks. And then we will talk about the debt instruments, the fixed income instruments, where we can say local currency bonds and US dollar bonds, or corporate bonds versus the sovereign bonds. And then we will talk about the derivatives, how to hedge, when to hedge, and when not to hedge. And then we will talk about the foreign exchange market, how to do forwards and futures, and how to calculate foreign exchange exposure. So once you have the tools, and at the same time, once you create those directional biases, we will be able to create a portfolio. The final section of the course, we will be able to create a portfolio based on all the feedback that we receive during the semester. We will use a multi-factor model to calculate an asset allocation model. At the country level, we will assign ETFs to each country so that the portfolio will be investable. So at the end of the course, you will have 15 reports written for each country, and then we will have a portfolio constructed for those countries, and that portfolio can be tracked against the EM index so that you can see your relative performance.